The US dollar has surged in volatility following former President Trump's latest statements, causing global investors to react with heightened caution as they anticipate potential shifts in economic and geopolitical strategies. Markets have responded quickly to Trump's comments, with traders recalibrating positions in currencies, equities, and commodities based on the perceived implications for U.S. policy and international relations. Analysts note that the dollar's movement reflects a mix of speculation, concern about trade dynamics, and expectations surrounding the Federal Reserve's future monetary decisions. Investors are closely monitoring how Trump's remarks might influence trade negotiations, tariffs, and economic agreements, which in turn could impact the dollar's relative strength across major currencies. The immediate response in currency markets demonstrates the sensitivity of investors to political signals, with sudden surges or drops in the dollar reflecting broader uncertainty. Global markets have seen increased volatility as the dollar reacts to speculation over fiscal policies that could affect national debt, budget priorities, and economic stability. Currency traders are focusing on how Trump's statements might shift expectations regarding inflation, interest rates, and U.S. economic growth, all of which influence the dollar's trajectory. The surge in dollar movement also reflects concern over geopolitical tensions, as investors attempt to hedge against unpredictable policy directions that could disrupt international trade. Financial analysts emphasize that the current fluctuations are not purely technical but are heavily driven by political news, highlighting the interplay between government actions and currency valuation. Emerging markets are particularly sensitive to the dollar's rapid changes, as many economies hold debt in U.S. dollars and rely on stable currency conditions for trade and investment. The volatility has sparked discussions about the resilience of the dollar, with some experts suggesting that temporary spikes may signal underlying uncertainty rather than long-term trends. Investors in bonds and equities are also reacting, as a stronger or weaker dollar can influence returns, import-export balances, and multinational corporate earnings worldwide. Trump's statements have reignited debates over trade policy, and any potential changes in tariffs or sanctions could have immediate effects on the dollar's strength relative to other major currencies. Financial markets have become more reactive, with automated trading algorithms amplifying the impact of any significant political comment or media coverage of Trump's statements. The dollar's response has created ripple effects in commodities markets, particularly oil and gold, which are typically priced in U.S. dollars and sensitive to currency fluctuations. Analysts are highlighting that investor sentiment is a crucial factor in this scenario, as market psychology often drives rapid movements even before policy changes are formally implemented. Some traders see the dollar's volatility as an opportunity to profit from short-term swings, while others remain cautious, waiting for clearer guidance on policy directions. The Federal Reserve's actions are being scrutinized, as any indication of interest rate adjustments or monetary tightening could either support or counter the effects of political statements. Global investors are reassessing risk, with the dollar serving as a barometer of confidence in U.S. economic stability amid uncertainty over potential policy shifts. Currency strategists are noting that while the dollar is traditionally considered a safe haven, rapid political developments can temporarily disrupt its perceived stability. Emerging market currencies are under pressure, as fluctuations in the U.S. dollar can impact local inflation rates, trade balances, and access to international financing. The geopolitical implications of Trump's remarks extend beyond the U.S., influencing global trade partners and prompting reassessments of bilateral economic strategies. Corporate executives with international operations are closely watching the dollar, as currency volatility can affect profit margins, supply chains, and pricing strategies. Investors are increasingly using derivatives such as options and futures to hedge against unexpected dollar movements, reflecting the uncertainty introduced by political statements. Analysts emphasize that the speed of the dollar's response demonstrates how integrated financial markets are with political developments, even before concrete policies are announced. The rapid movement of the dollar has triggered technical trading signals, prompting algorithmic systems to react automatically, sometimes amplifying short-term volatility. Central banks worldwide are monitoring the situation, as significant swings in the U.S. dollar can affect their foreign reserves and monetary policy decisions. Financial commentators suggest that the current environment requires careful risk management, as sudden shifts in the dollar could influence portfolios, investments, and corporate strategies. The dollar's fluctuations also highlight the interconnectedness of global markets, where political statements in one country can have immediate consequences worldwide. Investors are analyzing past patterns of currency response to political events, looking for signals that could indicate whether current volatility is temporary or indicative of a larger trend. Trade-sensitive sectors such as manufacturing and agriculture are particularly affected, as currency strength directly impacts export competitiveness and revenue. Economic forecasting has become more challenging, with analysts attempting to separate short-term reactions from longer-term implications of political statements. The dollar's movement is being closely watched by hedge funds, institutional investors, and individual traders, all seeking to anticipate the next market shifts. Financial news coverage has intensified, feeding back into market sentiment and often magnifying reactions to political statements. Some experts argue that the dollar's volatility may create opportunities for strategic investment, particularly in currencies and assets that are inversely correlated to the US dollar. Traders are considering both domestic and international factors, including interest rates abroad, trade deficits, and geopolitical tensions, which all interact with the dollar's strength. The dollar's rapid movement demonstrates the importance of market liquidity, as high-volume trades can either dampen or exacerbate fluctuations depending on timing. Analysts caution that the political influence on the dollar is a reminder of the complex relationship between policy announcements and financial markets, which is not always linear or predictable. Investors are increasingly paying attention to statements by influential political figures, recognizing that market perception often moves faster than policy implementation. Currency risk management strategies have become more prominent, with companies seeking to protect earnings from sudden shifts in the dollar caused by political statements. Some traders are employing multi-asset strategies to offset risk, including commodities, equities, and bonds, to navigate the current volatile environment. Global trade agreements are under renewed scrutiny, as any suggestion of changes in tariffs or sanctions can trigger immediate dollar movements and market adjustments. The market's rapid response highlights the degree to which confidence and expectation influence financial behavior, sometimes more than actual economic data. Dollar fluctuations have direct consequences for importers and exporters, who must adjust pricing, contracts, and risk exposure in response to market shifts. Investor sentiment surveys show heightened caution, with many market participants expecting continued volatility as political developments unfold. Economic indicators such as GDP growth, employment, and inflation are now being interpreted through the lens of potential policy changes, adding layers of complexity to forecasts. Financial regulators are monitoring trading activity to ensure orderly markets, particularly given the sudden and sometimes extreme movements in the dollar. The current volatility emphasizes the importance of diversified portfolios, as exposure to a single currency can lead to significant risk under political uncertainty. Emerging market debt denominated in dollars is especially sensitive, as sudden appreciation of the U.S. currency can increase repayment burdens and financial stress. Financial institutions are updating risk models to account for the impact of political statements on currency markets, highlighting the importance of adaptive strategies. Some economists suggest that while the dollar may face short-term swings, its long-term status as a global reserve currency remains largely intact. Investors are advised to remain vigilant, using both technical analysis and fundamental economic indicators to navigate a market heavily influenced by political developments. The speed of the dollar's reaction illustrates how quickly financial markets can process and respond to perceived policy risks and opportunities. Corporate treasury departments are reassessing hedging policies to mitigate potential losses from sudden dollar appreciation or depreciation. Global investment flows are being influenced, as sudden dollar movements affect returns on international assets and alter risk-reward calculations. The interplay between political rhetoric and market response underscores the psychological component of trading, where perception often drives action more than fact. Market analysts stress that while volatility may create opportunity, it also requires disciplined strategy to avoid losses amid unpredictable movements. Financial education and awareness have become increasingly important, as retail investors participate more actively in currency and derivative markets sensitive to political events. The dollar's rapid movement reminds stakeholders that no currency is immune to political shocks, and proactive risk management is essential in today's globalized markets. Overall, the reaction of the US dollar to Trump's latest statements reflects the complex interaction between politics, economics, and investor psychology, creating both challenges and opportunities for market participants. This situation serves as a case study in how political developments can influence financial markets almost instantaneously, shaping decisions for investors, corporations, and policymakers alike.